Inflation in the Philippines climbed to 2.9% in December, up from 2.5% in November, bringing the full-year average for 2024 to 3.2%. Now, this remains within the government's target range of 2 to 4%, but recent price increases in housing, utilities, and fuels are raising critical questions about the economy's trajectory as we move into 2025. Now, joining us live via Zoom to break down these inflation numbers and provide insights on what's ahead for the Philippine economy is Sanjay Mathur, the Chief Economist for Southeast Asia and India at ANZ Research. Sanjay, thank you for joining us all the way from Singapore.
Good morning.
Okay, Sanjay, you've got the bigger picture in view. You cover Southeast Asia and India. We got the latest inflation figures. Can you tell us from your lens, where does the Philippines stand?
Well, I think we can look at it from two perspectives. It would be fair to say that we are in a situation where inflation is slightly higher in the Philippines than the rest of the region. And I guess the real issue over here is that, there's a continuous adjustment of utility costs. Food prices, even the rice prices have come down. They have really gone up a little bit. And in that sense, inflation is slightly harder in the Philippines. Now, if you look at the other economies, there is extensive subsidies, et cetera, that are given out. That is not happening. In terms of growth, it's actually quite interesting. The Philippines is really an outperformer, and we expect the same to continue. Having said that, when I compare sort of Philippines against its own history, I think there are pockets of weakness. And one of the interesting anomalies we have right now is that we are at full employment, and yet if you look at private consumption, it's been fairly mild at this point in time. The other sort of two areas that are worth looking at, I think Philippines has one of the most impressive infrastructure development programs on the plus side. On the negative side, we are worried about Philippines' export performance. It just doesn't seem to be taking off at this point in time, and that's something we are going to have to monitor for the rest of the year. So clearly a fairly mixed scorecard when you look at growth and inflation together.
Yeah, a mixed scorecard. Okay, now in terms of GDP, other firms like Citi Research in particular, they say that economic growth may fall short of the government's target as typhoons in the third quarter weighed down output. They trimmed GDP for 2024 to 6% from 5.8%, which is slower than the government's 6 to 7% target. What are your thoughts on this? Do you share a similar view?
We do share a similar view. Actually, we have a forecast of 5.7% for the year, and we think that that's for 2024, and we think 2025 will be roughly similar. Having said that, it's not for us, it's really also about the fact that exports haven't picked up. 2025 will have significant volatility globally, and all those factors are going to weigh on investment decisions, on consumption, etc. And that's the reason for our relatively downbeat assessment. Now, having said that, when you put Philippines in a regional context, it still looks to be far more resilient.
Yeah, that's great. And the government is in an easing cycle. Since August of last year, interest rates have been cut by 75 basis points to help propel the economy, to help it stay resilient. What are your thoughts on interest rates moving forward as we come into 2025? Do you think that the BSP is going to continue with its easing cycle vis-a-vis what's going to be going on in the U.S.? Because that sets a big tone for what's going to happen over here.
Yes, so I think that we have exactly now the same sort of, we've got 75 basis points of rate cuts priced, or rather, we are forecasting 75 basis points of rate cuts. And that sort of puts the Philippines in a slightly more sort of aggressive easing mode compared to some of the other economies. Yes, the US sort of Fed cycle will matter a lot, but perhaps less so in the Philippines than others, and that's for two reasons. One, the Philippines is not that reliant on capital flows, and the second is that even if we do take into account the capital flows may slow down, I think the Philippines has shown a slightly higher threshold for a weaker peso. So put together, I think there is a lot more policy autonomy available for the Philippines.
Okay, you say we have a higher threshold for a weaker peso. To what levels? Because all of this monetary policy easing, your expectations are for 75 basis cuts more through to 2025. Where will that put the local currency?
So if you sort of look at how, the peso has moved, there was a time when 56 or 57 was the threshold, increased to 58. And now I think it'd be fair to say that a peso at 60 will not create any problems. One important aspect of this is that the impact of a weaker peso or domestic inflation has progressively come off.
Okay, and just some fun questions before we let you go. Super quick questions. Sanjay, if you could describe the Philippine economy in one word, what would that be?
Stable.
Stable. Was that it? Stable? Okay, that's a good one. What's one underrated strength of the Philippine economy?
The people.
The people. Okay, and if you could fix one thing about the Philippine economy, snap your fingers and fix one thing about the economy, what would that be?
Increased competition.
All right. Thank you so much, Sanjay. It was a pleasure to have you. Thank you for joining us all the way from Singapore.
Thank you.